All right, so Indian equity market have remained volatile since the start of the year. Amid such volatility, many investors seek foreign markets such as that in the US to diversify their investments. So should you think about investing in the US equities? How can investors capitalize on currency hedge? Let's answer all of these questions with Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisor India. Kaustubh, good evening and welcome to the show. And we are going to explore all the angles of investing in the US market, specifically to diversify or to add that touch of diversification in your portfolio. So, currently, just explain us how exactly are the US equity market placed?
Yeah. So, Kavita, I think that we're having this conversation at a very good juncture. Obviously, I think we've been very strong proponents of international diversification. And let me just, quickly, to address your question about, where the US market's placed, right? So there have obviously been, headwinds for the US markets given, where, the economy is headed, with inflation concerns, Fed hiking aggressively. But what we've seen in the past 1 year that, in 2022, especially calendar year 22, there was a sharp drop in the US equity markets, and obviously relative the Indian equity markets did outperform. In the last 3 months, the first 3 months of 2023, there has been a recovery in the US markets, especially on the technology sort of, some of the communication, media, entertainment names. But that valuation gap still exists. So I think broadly, I mean, the US markets are obviously poised at a very interesting juncture with, I mean, there are clearly some headwinds in the short term. But I think the overall thesis when we think about investing in a market like the US, that still remains intact over the long term. And we can kind of discuss that through the show.
Kaustubh, also explain us when we talk about international exposure to your portfolio or maybe diversification of that type, why should we consider only US markets at the current juncture?
So I wouldn't say it's necessarily a case only for the US markets, but when you think about just the options that are available to an Indian investor right now, especially through a India domiciled fund route, a majority of them are sort of US based. That's one, obviously, and I think secondly, I think US markets being the world's largest economy, being home to some of the largest corporations, global corporations, the most innovative corporations around, definitely makes a compelling case to have allocations towards US equities. You can definitely look at other markets across the globe, but I think US markets definitely, from a long-term perspective, an Indian equity investor should be looking to allocate some of his or her capital towards that. And let me just outline some of the reasons that I kind of alluded to, right? So, like I said, some of the largest corporations in the world that reside in India, in the US. And remember that these are corporations that don't have business only in the US. They have businesses all across the globe. And, let's just give you some quick stats. And everyone talks about these global corporations. But just some quick stats around when you look at the large benchmark indices, be it the NASDAQ 100 or the S&P 500. From the NASDAQ, only about 50 odd percent of the total revenue of the NASDAQ 100 companies actually comes from the US, right? The remaining comes from outside the US, so truly global and, even in their revenue spread. So you're getting exposure to a corporation that has, revenues coming from all across the globe. In fact, India accounts for about 1.5% of the overall sort of revenue coming in for the NASDAQ 100 companies. Similar stats for the S&P 500, probably slightly more US centric given the spread of the companies that are available. About 60 odd percent comes from US revenues, but the remaining 40 comes from outside, and about 1.5% again coming from India. So I think these are all brands and companies of which products and services we are very well acquainted with, right? So why not participate in the growth of these companies, which are really leading edge, cutting edge in terms of their innovation and coming in with products and services, which an Indian investor otherwise would not have access to necessarily from a local market context. So I think that adds a lot of value to your portfolio, in terms of, so we speak about diversification. Here's a diversification that, can happen in terms of company type, product type, obviously geographical diversification, because the other thing that, has played out in the past, if you just look at calendar year returns of say Indian equities versus US equities and some of the other international markets, they always work in tandem, right? So there'll be years where Indian equities, for instance, 2022 was a classic case in point where Indian equities are relatively much better than US equities. But if I just take it back in time to the years of 2019, 20, 21, especially 19 and 20, US equities significantly outperformed Indian equities, right? So you need to be invested in those markets to make the most of it when the run up happens again. And that's where you can really aid in diversifying your portfolio, not just typically by asset class or by market capitalization, but by geography of the businesses that you're kind of investing in.
Sure. So this diversification should be like a broad-based diversification, or we can also take a thematic route when it comes to international exposure and specifically US equities.
Yeah, I would think I would lean towards taking a more broad-based diversification. For most investors, that would probably be the ideal route. So typically, your more broader indices would, have a good representation of the largest companies, like I said, which are US domiciled, but, have operations all across the globe, right? So, and there are two primary indices that, people track. Obviously, there's the NASDAQ 100, which is typically overweighted more towards sort of the technology communication services names, so it doesn't have any financials exposure. Or you have your S&P 500, which also includes your financial exposure within that broad-based so these are the two broad US indices that investors can look at, and obviously there are options available to them across both of these. I think thematics would only be useful for an investor who wants to express a certain view, that who's very, very positive, say on a certain set of stocks, or more pro value or growth. If you want to do a style-based diversification, would look to expose themselves to that. Otherwise, I think a broad-based would work best for most investors.
How can one capitalize on the currency hedge here?
So this is something that people do kind of reproduce. So remember, your investments, when you're eventually you're investing in a fund, while it's rupee denominated, the end investment that the fund is making is either into US stocks or a US based ETF or a fund which is obviously US denominated, right? And essentially what happens is, so your end investment is actually US dollar denominated, and given traditionally we've obviously been high growth, high inflationary economy with higher interest rates. The rupee has depreciated against the US dollar, and obviously as US inflation and interest rates kind of normalize over the years, the rupee could tend to, that's what macroeconomics suggests, to continue to kind of, depreciate versus the US dollar. So what that does is then will essentially allow you to take a US dollar exposure, which could also help you in kind of getting some currency appreciation. While that's not the primary motive, but a lot of people, say for instance, have goals for their children or whatever to say study overseas, and we've all faced the brunt of it, that costs of education are going up. With a depreciating rupee, the cost of education get exacerbated even more. Here is an investment where not only will it benefit from the fundamentals of the US economy, but also perhaps just from the rupee depreciation that could play out over the coming years.
One question, that's coming on my mind is, since we all know that in a globalized world, economies are really connected with each other. So when we talk about international diversification, is it really diversification in its true sense? And for that matter, US equities?
Yeah, absolutely. So I think that's a very good point, Kavita, because I mean, we always imagine that we are one global pool of assets, and that's how economies are definitely going to be kind of not necessarily moving in tandem, but taking a cue from each other. But markets always can move in dissonance, right? And that's actually what we've seen in the past, and we expect that to continue to play out. And if you just look at, and we've, for convenience, we've kind of broken it down into, say, calendar year returns of the broader Indian indices versus the two frontline US indices that we spoke about. And we've seen pockets of time. I alluded to that in the earlier sort of discussion also, that 2019 and 20 were great years for the US, sort of markets versus relatively to the Indian markets, right? In fact, 2020 is a specific case in point where the tech stocks did exceedingly well. The NASDAQ 100 was almost up 50% versus maybe about 16 to 20% for the Indian indices. The S&P 500 probably not so much. It was only up about 18-20%. But 2019 we had both of these indices up between 30 to 40%, whereas the local markets were only up 10-12%, right? We know that changed in 2022. We've seen this in the past also. 2013, let me take you back 10 years. 2013 was another classic case in point where the dispersion of returns was massive between the Indian markets and the US markets. The US markets, both these indices were 30% plus for that calendar year in 2013, whereas the local Indian markets were in single digits, about 6 to 7%. And this completely flipped in 2014, where obviously post the election results, the Indian markets ran up while the US markets posted reasonable returns of high teens. The Indian markets are about 35-40% up, right? So this interplay of market movement continues to happen. Obviously depending on where people see valuations. If a market's relatively undervalued, can move up. So I think definitely that aids in diversification if you're buying asset classes which on a long-term basis could potentially be correlated, but the short-term movements can kind of help pad your returns and give a lot lesser volatility on an overall portfolio construct when if one equity asset class is not moving, the others relatively doing better.
And here is the question, which is related with the US vulnerability of recession, So, why invest in such an economy after all? We are one of the fastest growing economies in the world. And for international exposure, why choose an economy that is vulnerable and that has a risk of recession also? Especially in the near term outlook. Obviously, when you are making a portfolio and you are adding diversification of a concerned geography, but then you really need to understand the kind of phases that economy is going through and need to be very specific, with your entry timing. I think you've mentioned this earlier also in your answers that this is the time when you can. Do you think the valuations are really right looking at the risk which is still ongoing? What kind of exposure to start off with you can and maybe increase it later on, as the risk fades?
Sure, sure. I think that's a very valid question, Kavita. And I think let me address this through a couple of pointers, right? So one is, you're right. I mean, there are some short-term pains with regards to the US economy. Obviously, there's the looming recession that could potentially come, the inflation, that they haven't seen for so many decades. And obviously the Fed's being, aggressive in their rate hikes. There's the oil price, and, being spoken about that oil prices are moving upwards given the OPEC production cut, which could also have an overhang on the inflation. All of these short-term problems do exist with the economy, which could potentially be an overhang in the short term. But just going back to my earlier point about when we think about the U.S. markets, while they could be companies that are operating out of the U.S., these are truly global businesses, right? So I mean, if you're looking at the Nasdaq 100, only 50% of the revenues are actually coming from the U.S. and the remaining from outside the geographies, and you're getting exposure to companies which otherwise you wouldn't necessarily have exposure to from an Indian perspective. And like I said, we're all users of this. So, for instance, if you're using a computer, you're either on a Windows computer or a MacBook, right? And these are two of the largest listed corporations on the US indices. We all use Google, we all use Facebook. There are a lot of us using Netflix. So I think these are all corporations that, while present in the US, have a lot of corporations or revenues coming from outside. So in that sense, at least to a certain extent or to a large extent, they're not completely dependent only on the US economy to drive their revenues, right? So I think that's a very important thing to keep in mind. And the exposure that you're getting to this economy, which otherwise, like I said, you wouldn't be available to you necessarily from an Indian context. In terms of timing, obviously we talk about valuations, and like we said that US stocks or the markets have been in the undervalued zone for about the last 6-9 months. Since the large part of 2022, because of the steep correction that happened in the markets, especially on the tech stocks in the year of 2022. Some of this undervaluation has gone away simply because there's been a reasonable run up in these stocks in the past 3 months. But I wouldn't think of that only as the trigger to move in, because I think timing can be fraught with a lot of timing risks in terms of trying to just chase valuations and come in. The compelling argument is buying these businesses, buying the diversification benefits, getting exposure to companies that you cannot otherwise get. And that's why the best route for any investor, we always recommend it, come in systematically. I know there are challenges in terms of, which funds are open, which are that. So that's something investors will need to figure out for their advisors. But definitely come in systematically and probably add, about 10% of your equity portfolio to international funds. I would say a large part through US funds would definitely add, great sort of diversification and return benefits over the long term to your portfolio.
About the choice of index, S&P 500 and Nasdaq 100 clearly have the largest corporates in the nation and also have a fair strong value proposition here, but then there are other choices of indices as well. How can one decide?
Yeah, so I would say just try to think about where you want to be leaning towards your exposure, and there is no right or wrong answer, to be honest, because these are two very, very broad and well-tracked indices. So I would actually be indifferent between both of them, the Nasdaq 100 and the S&P. Obviously, I think one thing we must acknowledge with the Nasdaq, it is tech-heavy. It does have, for instance, your top five would, account for more than 40%. So it is a little kind of concentrated in the sense in terms of the top names really weighing on the overall index performance. While that is also the case with the S&P, but to a much lesser extent. So that's something that you would want to evaluate as an investor. But otherwise, I think broadly, both are great opportunities to take US exposure. You would get exposure to some of the leading names across both indices. One obviously, albeit no financials exposure. One getting in some financials exposure through the S&P 500. So that's some of the sort of portfolio calls that you would want to take.
And what will be the best way for Indians to invest in the US markets? Should there be direct investment strategies, or one should be going through AMCs? And as you earlier mentioned, also one should be going through funds and having the SIP route, which is safer for them.
Yeah, I would definitely do an SIP through the funds that we have domiciled in India. It's the cleanest is the easiest way of doing it. Obviously the other option of doing the LRS, which is it is a very operationally hassling tool. So, uh, obviously subject to which funds are open right now, given the caps that are in place. I'm given to understand quite a few of these are currently open, so investors can evaluate which exposure they want to take, and definitely do an SIP in those funds.
At the funds return, okay, last 1 year looks really negative, but then the returns before that really make them hard to ignore. So, what should be the placement? How much should be the exposure? Suppose if one is supposed to be entering this market through maybe a fund of fund or an ETF, what should be the exposure like in the portfolio?
Yeah, I would say maybe about 10% of your overall equity exposure you want to add and do that systematically. And like you said, the near term returns haven't been great, and that's probably the right time to get in, right, because like I gave the example of 2013 and 14, what we saw was we had this significant run up in US stocks, the markets in 2013. A lot of money came into US funds in 2014 after the run up had already happened. And then, people went overboard, invested a lot of money into US funds, and that's when the tide turned and the Indian equity started doing well, right? So we want to avoid that chasing of recent performance, rather just systematically decide that, look, I want to invest an X percent, which is, typically I would say 10% is a prudent sort of number to start with for your portfolio. Put that SIP in place into US markets. Don't worry so much that, is the valuation in the fair zone or slightly overvalued or undervalued. Let, kind of time be the best friend for you in markets like these.
Uh, Despite the shifting tax landscape, how attractive do you think are international funds even now, and what all one really needs to take care of?
Yeah, so that's, I think diversification benefits still remain a very compelling choice. Yeah, I mean, obviously tax has changed, and there's nothing that we can really do about it. And my advice to investors would clearly be that go on the merits of the product, not necessarily what the taxation is, because we've seen that tax laws can change at any point of time. So we shouldn't really be basing our decision purely on what the taxation is. Obviously, it does weigh on your decision, but the merit of the product would be the predominant deciding factor. And then definitely, like I outlined in the discussion, there are enough merits to make an investment in US equities.
All right, I think we've addressed all the questions related to investment in US equities for our viewers. Thank you so much, Kaustubh, for being on the show and helping our viewers with that. On
Thank
that
you.
note, we'll take a quick break, and after that, let's talk about SEBI's rule on PMS cybersecurity and how are your investments safe with all the fund houses. All of this and more after this break.